Why is hedging an unprecedented commodity weather risks so hard? Imagine trying to protect your crops from a storm that might hit tomorrow but could also miss your farm entirely. Weather impacts on commodities are just like that, unpredictable and often localized. Unlike stock prices, which can sometimes be forecasted based on economic data, weather events happen suddenly and vary greatly from one place to another. A drought might devastate crops in one region but leave neighboring areas untouched. This makes it tough to create financial tools that truly match the real risks farmers or commodity producers face. Traditional hedging tools like futures and options work well when prices move in predictable ways. But weather risks are tied to physical events, not just market trends. Weather derivatives, which pay out based on temperature or rainfall levels, were created to fill this gap. Still, these are often customized contracts traded over the counter, which means they are less liquid and more expensive. That makes it harder for many investors to use them effectively. Another big challenge is the lack of reliable data for unprecedented weather events. Hedging relies on past weather patterns to estimate future risks. But climate change is causing weather to become more erratic, so historical data may no longer be a good guide. Without accurate data, pricing weather derivatives becomes guesswork, and structuring effective hedges gets even more complicated. Liquidity is also a problem. Many weather derivatives are designed for specific locations or conditions, so markets for these are thin. It can be difficult to buy or sell these contracts without influencing their prices, which can make hedging costly. In contrast, energy futures like oil or natural gas are traded in large volumes, making them easier to use, but they don't directly cover weather-related risks to crops or other sensitive commodities. Managing weather risk also requires a mix of skills. You need financial knowledge, but also an understanding of meteorology and local farming conditions. Investors must keep an eye on weather forecasts, crop reports, and global supply chains. This kind of detailed monitoring is more complex than just tracking market prices. All these factors mean that while hedging can help reduce weather risks, it cannot eliminate them completely. Investors often accept some exposure to weather fluctuations. Spreading investments across different commodities and regions can help, as can combining financial tools with insurance and supply chain strategies. But the unpredictable nature of weather and the limitations of current hedging options mean some risk will always remain. In the end, many commodity investors focus on managing what they can control, like diversifying their portfolios, maintaining liquidity, and staying informed about weather patterns, knowing that total protection against unusual weather events isn't yet possible. This approach shapes how they plan their investments and decide which commodities to include in their holdings.